Good morning, this is Mark Bowd of Real Estate Economics. Thank you for joining us for our webinar series here at Real Estate Economics. Our topic for this morning is the entire nation. We want to present specific information regarding the nation's economy as well as the housing market and what the next 5 years will likely look like as we continue in this recovery mode. There are a lot of concerns out there, a lot of negative press as well as some positive press, and we wanted to shed some light as to what all that means. So, for this morning, let me actually show you a clipping from the New York Times. This was dated July 8th, just a few days ago. It says job growth falters badly, clouding hope for a recovery. And in the body of the report it stated, for the second consecutive month, employers added scarcely any jobs in June, startling evidence that the economic recovery is stumbling. All levels of government shed workers, and hiring by companies continued to slow, resulting in a meager 18,000 new non-farm payroll jobs last month. The government also revised downward the small gain for the previous month to 25,000 new jobs, less than half the original estimate. A pretty gloomy article, and newscasts shed this in the most negative light possible just a few days ago. But I wanted to share with you that just a day before that, the ADP National Report, which is widely recognized as the most objective and widely followed report regarding private employment, had a completely different spin on employment. June 2011 ADP National Employment Report stated employment in the U.S. non-farm private business sector rose 150,000 jobs from May to June on a seasonally adjusted basis. The estimated advance in employment from April to May was revised down, but only slightly, to 36,000 from initially reported 38,000. Today's ADP National Employment Report estimates employment in the service providing sector rose by 130,000 jobs in June, nearly 3 times faster than in May, marking 18 consecutive months of employment gains. Skipping down a little bit, these figures are above the consensus forecast for today's report and for Friday's job number from the BLS. And it's the numbers from the BLS that were quoted by the New York Times. So really what are seemingly completely contradictory reports. One is very, very positive, the other is quite negative, just a day apart in terms of when they were posted. I wanted to make a couple comments. Obviously, news from the newspapers tries to be as dramatic as possible, and I think that part of that negative spin was trying to be as dramatic as possible, ignoring some of the other data that was out there. Hopefully ADP tries to be as objective as possible. They are known for their objectivity. They're just trying to post those numbers from the private sector that have meaning. And so I think there's meaning in both of these articles, though the objectivity, I think, slants far more toward the ADP report as opposed to the New York Times. Having said that, there are truths in both reports, and I wanted to explain that a little bit. This report, this chart generated from Real Estate Economics, shows overall 12-month changes in non-farm employment from the early 1990s forward, including a 12-month forecast that's set forth by my company. And here's what they're really talking about in terms of that negativity. Here we were at creating well over 1.4 million jobs, pushing 1.5 million jobs during the past 12 months in April. Then it slid down quite a bit in May, and it stayed down in June. Now our forecast suggests that it will go back up into more of a normal growth pattern in terms of recovery. We still think that that will happen. Part of the reason that May and June were down, obviously, is because that's what happens when you push gasoline above $4 per gallon. And May and the first part of June were certainly like that. We think that July numbers will be better, but only gradually so, and will improve. We'll kind of still have these feelings of bumping along a bottom. It'll take quite a while to fill the hole we've dug. Let me show you the composition of what's occurred during the past 12 months. You can see that most of the losses in terms of jobs were made in the government sector. The government sector lost almost 850,000 jobs from May 2010 to May 2011. Almost every other sector gained jobs, only a slight decline in jobs in the financial activities sector and the information sector. This is quite a positive report, despite the fact that most of the positive private growth was offset by a huge number of jobs lost on the government sector. I think in the long term, that's not necessarily bad news, as we are being forced to shed jobs in the government sector to reduce our debt exposure. I think this needs to happen, and so we're going to see this pattern continue for the next little bit, but the private sector continues to create jobs, and that's really what we ought to be focusing on. This is what it looked like a year ago. Between May 2009 and May 2010, notice that government growth was positive. In fact, it was really the driving force. It was the largest job gainer, and almost every other category or almost every other industry was losing jobs at that time. This is what it looked 2 years ago, from May 2008 to May 2009. Again, government was positive. We were seeing huge losses in professional and business services, construction, manufacturing, and trade. So we have arrested the losses in the private sector. Those have now turned positive, and we flipped to dramatic, significant losses in the public sector and in the government sector. And again, that hurts. That makes us feel badly overall as we continue to bump along a bottom. But overall, in the long term, I'm not sure that that's a bad thing as we correct the enormous deficit that we've built up and the debt that we've built up over the past few years and trying to dig ourselves out of the recession via Keynesian economics. So for the next 5 years, this is what we think it looks like. Despite the fact that overall employment growth has slowed, we still think that we're on pace to create on an annual basis almost 1.4 million jobs during year 2011 from where we were in 2010. Thereafter, we think it exceeds 2 million jobs or more being created for the next 5 years. Now, keep in mind that though this might seem like at least normal job growth, it's going to take at least 3 to 4 years of job growth above 2 million to even get back where we were. Notice that we lost about 7 million jobs during the recessionary years. So we need 2 to 3 years of very, very strong or stable growth over 2 million to get back to par, and then we begin to feel the impact of growing employment thereafter. So despite the fact that we will be creating jobs, it takes a while for that to filter down into the economy and really begin to move the economy forward. There's some other factors that we should be looking at, and one big one is that we're not building any homes. Construction remains at an all-time low during year 2011. And we think that those very slow construction patterns will continue for the next few years. We don't hit some form of normalcy until about 2016, where we exceed 1 million jobs created on an annual basis, which begins to match a long-term average. And that's actually good. It allows the economy to pick up and for demand to catch up with the supply that's out there. Despite the fact that we're not building any homes, there's still a lot of supply that's out there. Much of it is distressed. And here's some insight regarding distressed housing. What this is a chart that shows the percentage of mortgage payments that are past due. Anything that's over 30 days, 60 days, and 90 days, this is the percentage of those mortgages, of all mortgages that are overdue. And note that the long-term average probably hovers around 4.5% to 5%. It wasn't until 2007 where it really began to shoot up. We exceeded 10% in 2009 and 2010 before it began to fall in the latter part of year 2010. And it has fallen. We've actually come down close to 8% in the most recent reports, and that's a good thing. We think that there will be bumps along this road as well, but at least we're heading in the right direction and have been doing so for a few quarters now in terms of the percentage of mortgage payments heading downward. Still well above our average, but at least heading downward. Another factor that needs to be paid attention to is long-term mortgage rates, 30-year fixed rate mortgages. Right now they are at about 4.5%. They've actually come down during recent weeks. And July, the first part of July, has been a good time for lower mortgage rates after being a little bit higher in June and in May. We think that it kind of bumps along that bottom for another 12 months or so before it begins to rise. We've actually revised this downward from where we were last quarter, but we still think that it rises fairly significantly and begins to toy with about 7% by end of 2015, 2016. Population changes need to also be paid attention to. Most of the growth in population will occur between the ages of 55 and 74, and that has a pretty dramatic impact as to the types of homes that we should be building. A lot of those homes will need to be directed toward the retirement or pre-retirement active adult sector. It doesn't mean that we can't sell homes in these other age categories, but it just means that the incremental demand will not be as strong in those categories. All of this information flows into our supply and demand model. Demand is shown by the green curve, supply is shown by the blue curve. When there are mismatches between the two, there is either excess supply, which is below this equilibrium line, or excess demand, or pent-up demand, which is shown as those areas which are above the equilibrium curve. Here we are right now. We're coming off the very dramatic levels of oversupply, but we're still grossly oversupplied and will continue to be so. It's not until about 2014 where the market really begins to tighten. And thereafter, we think we'll actually form another cycle of undersupply, and we think it might be a fairly dramatic cycle given the fact that very little construction is going on and very little is actually in the pipeline. There is another side of this equation, and that's the valuation side, or the affordability side. In this case, the blue curve represents where median prices of homes have been over time, or where we think they will go during the next 5 years, while the green curve measures where we think they ought to be based upon a combination of median household incomes, and mortgage rates, and other factors that directly impact monthly costs. When there's a gap between the two, as there was between 2004 and 2008, that was a formation of a bubble or overpricing. Now we've actually flipped that equation, and we're in a state of severe undervaluation. It started with the severe drop in prices that was caused by the financial crisis, and that continues to this day. So despite the fact that we were extremely out of balance and unstable in 2005, 2006, 2007 due to overpricing, we're unstable right now almost as much as we were back then in 2006, 2007. But in this case, we're unstable in terms of undervaluation. If we are to head back toward long-term norms, that long-term relationship between household incomes and mortgage rates and prices, monthly costs, we think that prices need to go up, or a combination of prices going up and mortgage rates going up will force us back down to equilibrium and create a new cycle. Here's where prices have been over time. Here is that overvaluation, that bubble that I talked about. Here's that undervaluation where we are now, and here's our projection for the next 5 years. Notice that where we are now pretty much matches a little bit higher, or kind of in between where we were in 2002 and 2003. Where we're heading, even by 2016 after our forecast, we're still only till about 2004 levels. And here is that forecast in terms of percentage changes. We actually see a very slight negative across the nation in 2011. I know in some areas we posted more of a negative, in some areas we posted a positive, but overall it remains somewhat flat during year 2011, before we see marginal appreciation during year 2012, and then it picks up thereafter. So to summarize what we think will happen on a national basis and what is going on a national basis, more areas are suffering than improving right now, but the signs of private employment growth remain intact. And unfortunately, it's going to take another couple years of fairly strong or stable private employment growth, as well as a reduction in the losses on the public sector, before the market really begins to feel solid and begins to see increases in price. Housing construction is near an all-time low. Housing affordability is near an all-time high. A severe overcorrection is already well established. High numbers of defaults continue, but distressed inventory is beginning to head downward, though it will remain a problem for at least another 3 years. Prices will range, or price changes will range anywhere from a negative 3% to a positive 3% in most areas. Most of those areas that will see positive changes in price will hug the coast. Most of those areas that will see negative changes in price will be those areas that tend to be inland or tend to be areas that are not supply restricted. Areas like Phoenix, Las Vegas, and so on. Transaction volume has fallen, reflecting continued instability, poor sentiment, and low economic expectations. That's going to continue for another few quarters. Market improvements in the year 2012, and we do think that there will be fairly significant market improvements towards stability. Those will initially be driven by undervaluation as opposed to economic growth. Even though we're seeing economic growth now, and we will see it in 2012, we need to fill the hole completely before we really begin to see economic growth driving the housing market. We don't think that occurs until about 2014. So it first gets driven by undervaluation. Market demand in the next cycle will be driven by mature buyers, by mobile buyers, those who are chasing jobs from area to area, and even international buyers, as many international buyers seek to take advantage of a very low dollar. Just to remind you, we offer consulting services as well as web-based information tools, and we invite you to contact us at Real Estate Economics for those services and tools. Thank you for joining us. If you'd like more information, here's our contact information that I'll leave up in just a bit. Thank you. We hope you'll join us for our next webinar in the next couple weeks as we shed some additional light on the impact of renewable energy on the housing market. Thanks. Take care.